If you were born before 1961, there is a good chance you have been paying bills for years that you may not need to pay in full anymore. And the most surprising part is this: no government office, tax agency, or county department is likely to contact you and tell you about it. Think about that for a moment. Many people believe turning 65 only unlocks Medicare, but in reality, reaching that age can also open the door to a variety of tax breaks, property-related benefits, healthcare savings programs, and cost reduction opportunities that millions of retirees either overlook or never hear about at all. The problem is not that these programs do not exist. The problem is that qualifying for them and actually receiving them are two very different things. Every year, countless retirees continue paying expenses that could have been reduced simply because they never submitted a form, asked the right question, or checked whether they were eligible. There is no automatic alert. No official reminder arrives in the mail. No agency calls to tell you that you may be entitled to savings. As a result, money quietly leaves bank accounts month after month, while many people assume everything is being handled correctly. Before you assume this information does not apply to you, consider something important. Some retirees believe these benefits are only for people with very low incomes. Others assume they are designed exclusively for wealthy homeowners with large estates and professional advisors. In reality, both assumptions can be wrong. Some programs provide the biggest advantage to retirees living primarily on Social Security. Others can be especially valuable for homeowners whose property values have increased significantly over time. There are even benefits that indirectly affect renters by helping control housing-related costs. That is why it is worth taking a closer look at what may be available. Let us begin with one of the newest tax advantages available to older Americans. Many people are unaware that qualifying seniors may be eligible for an additional tax deduction that can reduce taxable income significantly. This benefit is separate from the standard deduction and can provide meaningful tax relief for eligible taxpayers. For married couples where both spouses meet the age requirement, the potential reduction can be even larger. What makes this particularly important is that many taxpayers assume software, tax preparers, or filing systems automatically apply every available deduction. While that often happens, mistakes can occur, especially when personal information is incomplete or incorrectly entered. Something as simple as an incorrect birth date can affect eligibility calculations. That is why reviewing your completed return carefully before filing is one of the easiest ways to protect yourself from overpaying taxes. A few minutes of verification could potentially save hundreds or even thousands of dollars. Now let us move to an area where some of the largest savings opportunities may exist: property taxes. Many homeowners pay their annual property tax bills without realizing that several separate programs may reduce what they owe. The first commonly discussed benefit is the homestead exemption. While rules vary by state, homestead exemptions generally reduce the taxable value of a primary residence before property taxes are calculated. That reduction can lead to meaningful annual savings. The key issue is that many homeowners assume the exemption is automatic. In numerous jurisdictions, it is not. Instead, a homeowner must submit an application directly to the appropriate local office. Once approved, the exemption may remain in place for years, but missing the initial filing can mean paying more than necessary. A second category involves senior-specific property tax exemptions. Many states provide additional relief once a homeowner reaches a certain age, often beginning at 65. These programs may offer further reductions beyond the standard homestead exemption. One of the biggest misconceptions is that every senior exemption requires low income. In reality, eligibility requirements vary significantly by location. Some programs consider income levels, while others focus primarily on age and residency status. Because local rules differ, it is important to contact the relevant county office and ask directly about age-based property tax benefits available in your area. Then there is another program that many homeowners find especially valuable: property tax assessment freezes or tax ceilings where available. These programs can limit future increases in taxable property values or certain portions of property taxes after a homeowner reaches a qualifying age. For someone living in a neighborhood where home values have risen dramatically over the years, this type of protection can make a substantial difference. Imagine owning a home for decades while surrounding property values continue climbing year after year. Without available protections, tax bills may continue increasing even if retirement income remains relatively fixed. Programs designed to limit those increases can help create greater financial stability during retirement. And even if you rent rather than own, property taxes still matter. Landlords often factor rising ownership costs into rental pricing decisions. When property tax burdens increase significantly across a community, those costs can eventually influence rent levels as well. That brings us to another expense many retirees pay every month without giving it much thought: Medicare premiums. For millions of Americans, Medicare Part B premiums are automatically deducted before benefits arrive. Because the deduction happens behind the scenes, many people rarely stop to consider whether assistance programs might be available. What surprises many retirees is that there are programs designed specifically to help eligible individuals with Medicare-related costs. Depending on income and other factors, certain Medicare Savings Programs may help cover premiums and, in some situations, additional healthcare expenses. Unfortunately, many qualified individuals never apply. Some assume their income is too high. Others believe their savings or home ownership automatically disqualify them. In certain cases, neither assumption is correct. Eligibility standards vary and can change over time, which is why speaking with an official assistance program or benefits counselor can be extremely valuable. A simple conversation may reveal options that were never previously considered. In addition to premium assistance, some individuals may qualify for programs that help reduce prescription drug expenses. For retirees managing multiple medications, even modest reductions in monthly costs can add up significantly over the course of a year. The important lesson here is simple. Do not assume you are ineligible based solely on what you have heard from friends, neighbors, or online discussions. The only reliable way to know is to ask and verify. Far too many people disqualify themselves before ever submitting an application, and that means potential savings remain unclaimed. In the next part, we will continue with additional overlooked programs, tax-saving opportunities, utility assistance options, and several bonus strategies that many retirees never discover until years later. Some of those benefits may be worth far more than people expect, especially for homeowners and long-term retirees who have spent decades building their financial security. Now let us continue with several additional opportunities that many retirees overlook, even though they can reduce everyday expenses and improve monthly cash flow. One area that often receives little attention involves communication and utility assistance programs. These benefits may not sound as exciting as a large tax break, but when multiple savings programs are combined, the impact can become significant over time. For example, certain qualifying households may be eligible for discounts on phone or internet service through assistance programs designed to help reduce essential monthly expenses. Likewise, there are energy assistance programs intended to help eligible individuals manage heating and cooling costs during periods of high utility usage. No single discount is likely to transform a retirement budget overnight. However, retirement planning is often about reducing recurring expenses wherever possible. A savings of $10 here, $20 there, and a larger benefit elsewhere can collectively create meaningful financial breathing room. The challenge, once again, is awareness. Many programs are available only to those who apply. No one automatically enrolls every eligible person. That is why taking the time to explore available options can be worthwhile. Now, let us talk about one of the most commonly overlooked tax issues affecting older Americans. Many retirees continue withholding more taxes than necessary long after their financial circumstances have changed. Sometimes this happens because withholding elections were established years earlier and never reviewed again. In other situations, tax preparers simply continue using the same assumptions year after year without considering age related deductions or retirement specific tax changes. As a result, some retirees effectively provide the government with an interest free loan throughout the year and then receive a refund months later. While receiving a refund can feel rewarding, it may actually indicate that too much money was withheld in the first place. Reviewing withholding levels periodically can help ensure that more money remains available during the year rather than being unnecessarily tied up until tax season. This does not mean everyone should reduce withholding. Every financial situation is different. The key point is simply to review and verify rather than assume everything is already optimized. A brief discussion with a qualified tax professional can often identify opportunities that might otherwise remain unnoticed. Now, let us move into several lesser known strategies that can be especially valuable for retirees who own property or have accumulated assets over many years. The first involves property tax deferral programs available in certain areas. Depending on local rules, some older homeowners may have the option to postpone portions of property tax obligations under specific circumstances. These programs generally allow qualified homeowners to preserve cash flow while remaining in their homes. Because regulations vary widely from state to state, it is important to understand both the benefits and long-term implications before making any decision. Still, for some retirees, these programs can provide meaningful financial flexibility. Another issue that deserves attention involves surviving spouses. When one spouse passes away, various exemptions, tax protections, or benefit programs may require updates, transfers, or new applications. Many families assume everything continues automatically. Unfortunately, that is not always the case. Missing paperwork during an already difficult time can sometimes result in the loss of valuable benefits. That is why surviving spouses should review property tax records, exemption filings, and related programs to ensure all available protections remain in place whenever possible. There is also another category of savings that people frequently dismiss because the annual amounts seem relatively small. Vehicle-related fees, registration discounts, and age-based reductions may be available in certain jurisdictions. Individually, these savings might not appear substantial, but retirement finances are often improved through a combination of many small advantages rather than a single dramatic change. The individuals who benefit most are often those who consistently identify and claim every program for which they qualify. Now, consider a real-world example that illustrates how these opportunities can work together. Imagine a retiree living alone in a home that has appreciated significantly over the years. The mortgage has already been paid off. Income comes primarily from Social Security along with a modest pension. Everything appears stable on the surface. Bills are being paid, taxes are being filed. Nothing seems obviously wrong. Yet after reviewing the situation more closely, several opportunities emerge. The homeowner discovers that a property tax benefit was never claimed. A healthcare assistance program had never been explored. Tax withholding levels had not been reviewed in years. None of these issues resulted from carelessness. No laws were broken, no mistakes were intentionally made. The retiree simply never received clear information about available options. After completing a few applications and updating several records, monthly expenses begin to decline. The home remains the same. The income remains the same. The lifestyle remains the same. The difference is that more money stays where it belongs. That example highlights an important truth. Many financial improvements do not require taking major risks, changing investments, or making dramatic life decisions. Sometimes the biggest gains come from ensuring existing benefits are being fully utilized. That is why reviewing available programs every few years is such a valuable habit. Rules change, eligibility requirements evolve. New programs appear while existing programs are modified. What was unavailable 5 years ago may be available today, and what did not apply at age 60 may become relevant at age 65, 70, or beyond. So, what practical steps should retirees consider? First, contact the appropriate local property tax office and ask about homeowner exemptions, senior exemptions, assessment limitations, freezes, or any other age-related programs available in your area. Second, review Medicare-related assistance opportunities and determine whether any healthcare savings programs might apply to your situation. Third, examine recent tax returns and verify that all available deductions and credits were properly considered. Fourth, review utility, communication, and energy assistance programs if monthly expenses are becoming difficult to manage. Fifth, revisit these questions periodically, rather than assuming a previous answer will always remain correct. One of the biggest mistakes people make is assuming that because they were not eligible once, they will never qualify. Life changes, income changes, rules change, eligibility changes. Regular reviews can uncover opportunities that did not exist before. Another valuable resource involves volunteer tax assistance programs that help older adults prepare returns and identify potential deductions. Many retirees are surprised to learn that qualified assistance may be available at little or no cost. These services can be particularly helpful for individuals who want a second set of eyes reviewing their tax situation. Again, the goal is not to search for loopholes. The goal is to ensure that benefits established by law are being applied correctly. There is a major difference between avoiding obligations and claiming legitimate benefits. Every program discussed today exists because lawmakers created it for specific purposes. If you qualify, using those programs is simply exercising rights that are already available. Before making any financial decision, remember that rules vary by location and individual circumstances. Information discussed here is educational in nature and should not replace personalized legal, tax, or financial advice. Always verify details through official sources or qualified professionals familiar with your specific situation. The most important takeaway is this: do not assume that turning 65 only changes your healthcare options. It may also open the door to tax reductions, property-related savings, healthcare assistance, utility support programs, and other benefits that can make retirement more affordable. Unfortunately, many people never discover those opportunities because they never ask the questions. A few phone calls, a few applications, and a little research may reveal benefits that have been available all along. And sometimes those small actions can make a bigger difference than most people realize. Social Security Decoded.